today. A host of new retail investors flooding the market following that Reddit rally, but these new traders are in for a big surprise potentially. Taxes. Robert Frank has more. Hi, Robert.
Hey, Tyler. Well, accountants and tax preparers also getting flooded with business from all those new stock traders. They're just getting their 2020 tax bills. Now, here are the most common and costly surprises. There are really just three of them. First, many are learning that the gains held on stock less than a year are taxed at ordinary income rates, so as high as 37% rather than the cap gains tax, which tops out at 20%. Also, lots of mistakes around wash trades. That's where you sell a stock at a loss, buy it back to get the tax loss. The rule says, of course, you got to wait a month before the buyback, but many of these folks sold too early, and now they're not able to use that tax loss. And finally, lots of traders using multiple brokers, and unless you combine all those 1099 statements, let's say they bought one stock at Robinhood, sold another on Schwab, their actual tax bill is going to be a lot higher when you net all of that together. Now, one important piece of advice here for all those traders, maybe in GameStop or others who lost money, this could save you a lot. Between now and April 15th, please elect mark-to-market for your 2021 returns. If you don't, your capital losses that you can deduct against your other taxes for this year is capped at only $3,000. If you elect mark-to-market, you can use the entire loss against any gains this year, Tyler. So look, GameStop is up today, but anyone who's lost money in this first month of trading, if they elect mark-to-market, can use that entire loss in 2021 if they do that. So that's could save you a lot of money on your taxes.
The entire loss, let's say you lost $60,000 instead of $3,000. If you use the mark-to-market accounting, you can write off the entire $60,000 against other capital gains or against regular income.
That's right, and you can do that against either in the same year, and that's what's great about it. You know, if you don't do this, you can still use that loss. You just have to carry it out over 20 years or however it takes to get there, $3,000 a year. This way you can write off that entire loss against your income or against capital gains in 1 year. Now, you have to have tax trading status, which is a sort of separate thing you've got to do, a bit of a bureaucracy. But again, given the savings here, if you have a big loss in January, that could save you a lot of money. You got to do it by April 15th, so.
By April 15th, well, boy, I've been there on that $3,000 loss rule, and it pains me every time I have it. And it's happened quite a few times.
Yeah.
Robert, thank you very much. Seema, over to you.
All right, ahead on Power Lunch, streaming